Welcome to those who didn't make it to the CEs this morning. We talked quite a bit about retirement plans in general, and I thought I would take about the next 30 minutes just to talk about life insurance as an asset class in a retirement plan. And I'm going to echo a little bit of what was said earlier about the whole DOL and the fiduciary responsibility. I was saying to my boss 2 weeks ago, do I need to clean my desk off and brush up my resume? Because not only, is it going to impact all of you, it's also going to impact, the home office and, the retirement planning world in general. So, again, make yourself known in Washington. I never want to be one of those stalker kind of crazy people, but I do write a lot of letters to the people in Washington when it's very important, and I think this is really important. Again, I'm Cheryl Jorgenson, Vice President of Retirement Services with Lafayette Life Insurance Company. I've been in the business I've been with Lafayette almost 30 years, and I did 8 years with Principal Financial before that, almost all of it in the retirement world. So I've done a lot of accumulating of assets for other people. I was telling the group this morning, I've lost about half of my 401k plan at least twice in my career. So apparently I wasn't working with the right people. But anyway, I do have pension designations with the American Society of Pension Practitioners and Actuaries, which is another very strong lobbying group for this whole fiduciary thing, and the National Association of Pension Administrators. So we're going to talk about life insurance in a retirement plan. And I get a lot of questions about why would anyone want to do that? Does it make sense? In our world, I think that life insurance is just another asset class. There certainly are reasons to do it from that perspective, and that goes into what are the investment options and what's the fiduciary responsibility. So what kind of assets are you going to use in a retirement plan? Our focus is the small plan market, kind of the mom and pop shops. We're also focusing on defined benefit plans, okay, in that marketplace, because what happens is you've got older owners who typically are later in life before they start thinking about retirement, and they don't have a long enough time to accumulate assets like they would in a 401k plan. So a defined benefit plan is the only way they're going to be able to do it. Okay? So why would you want to use life insurance? It has guarantees, does it not, if you're using whole life? We're a whole life company. You've got some guarantees in there. What does it also do in the retirement world? Okay. It provides the retirement benefit in case premature death occurs. So as a participant, I may not personally care, but my beneficiary is going to really care, because that benefit's going to be fully funded at the point that that would happen. Let's just talk real briefly about what is fiduciary responsibility. Apparently the Department of Labor don't think we know what it is, but we have things on the books already. Okay, it's called the Prudent Person Standard for investing in retirement plans. Okay, the investments that happen have to be done the same way a prudent person who actually does that would actually invest. And it has to be in the best interest of the plan. So we've already got some of the things in place that this whole, regulation is encompassing. Let's talk a little bit about rate of return in a qualified plan. I talked this morning, in a defined contribution plan, you do want the largest rate of return you can get in a retirement plan, do you not? Because you put money in, and whatever you have at the end of the road, that's what you're going to take with you. Okay, in the defined benefit world, that's not as important, because the actuary tells us what kind of an interest rate we're using for our projections. And that's our bogey, if you will. So we don't want to, and we're guaranteeing a benefit, so we don't want to do a lot of gyrations with our investments, because we want to make sure the money's there at retirement. Okay? So right down to the meat of it, placing insurance in a retirement plan, it ensures the benefits at retirement and the payouts in case premature death occurs. Provides a death benefit to the beneficiary. And if a participant, what happens is you're insured from the first day of the plan. Okay? So your benefit, if you pass, your benefit is fully funded from that very first day. So you don't have to work 25 years or 30 years for that full benefit to be there. And the death benefits are typically immediately available. And what does that mean? Okay, is if death occurs, typically in a defined benefit plan, you don't get your monthly benefit until when? Until you retire, right? So if death occurs prior to retirement, how is the beneficiary, and typically that's your spouse, how's the spouse and your family going to live? Well, we're going to pay out the death benefit typically immediately when that happens versus waiting until normal retirement age. So there's some money there. We also are using, the premiums are part of the contribution. So we're using pre-tax dollars. Okay. What does that do? It takes less money if you're using pre-tax and if you're using post-tax, provides this pre-retirement death benefit, and if a plan is considered covered under ERISA, meaning there's at least one rank-and-file employee, you've got some creditor protection, meaning that you can't, no one can take those assets, you can't assess those assets in a retirement plan, with the exception of a qualified domestic relations order. Are there small business owners who may have careers that have some liability in lawsuit situations? The medical field, one of them. Okay, no one can attain these assets. So the premium is a part of the contribution. Yes. Yes. It's not covered under ERISA, so correct. That would be correct. Okay. Premium is part of the contribution, therefore it's tax deductible. The whole thing is tax deductible. Let's take a look at an example here. This happens to be a 412(e)(3) plan, which is a defined benefit plan that's funded exclusively with insurance products. So it's either 100% annuity or a combination of annuity and life insurance. So we've got an owner, a spouse, and one employee. If you did annuity-only funding, you've got a contribution of $130, $436. If you chose to do life insurance and the annuity, the contribution is $176.15, although it increases the deduction by $40,000. You've got significantly more life insurance than that, okay? So it's almost like it's on sale for the ladies in the room. We love sales, right? Okay. So it does increase the contribution in the 412(e)(3) world, okay? It's what we call split funding in this world. But it's not the full amount. It doesn't increase it by the full amount. You're still funding for the benefit. So in this world, what we're looking at is how much money are we going to have at retirement to provide the benefit. So we're looking at the cash value. Typically, this is going to be a whole life insurance policy. Under reduced personal expenses, what's it going to take? So say we've got the $67,342, which is the premium on the owner of the business. Okay. If someone's in a 30% tax bracket, personal taxes, they need almost $96,000 plus some change there to actually fund that premium. Okay. And again, it's almost like life insurance is on sale. Does it make sense to use pre-tax dollars for the purchase of life insurance? Okay. It is a needs-based sale, so it's no different than selling life insurance outside the plan. Does it make sense? Do they need life insurance? Does it make sense to do it in a retirement plan just like you would do it outside? Okay. So we do know that in a retirement plan you have to pay what they call PS58 costs. The participant is $10.99 for the pure cost of the insurance. It's called a PS58 cost. Anyone who's worked in the split dollar arena knows that That can be recouped at death, if death occurs, which is significantly lower than the taxable, the difference between the taxable and the the post-tax situation there. So you'll see that. Again, it's almost like it's on sale. Let's take a look at a profit-sharing plan. This is, I mean, this always astounds me. How many times have we heard that life insurance, you know, we know that life insurance doesn't have a lot of cash value in the early years, but it's more of a long-term thing. But if we're in the market, we think we can do better than life insurance. I hear it all the time. Why would I do life insurance? It's not a good investment, okay? So at year one, what we're doing is we've got a contribution of $44,000 going into the retirement plan in this situation. We've chosen to take 25% of that to purchase a policy. And we're using one of our whole life policies. For the investment part, we're going to assume 6% rate of return, which may or may not be high, low, or whatever, but we're going to assume 6%. So in the first year, if death would occur, the proceeds from the policy are $405,000 plus some change. Our investment account at that point is worth $34,980 for a total of $440,737. If we had investment only in our retirement plan, our payout $46,640. Okay, as an agent, which would we rather, when you're going to the beneficiary, the spouse's home, which would you rather give them? Okay, so this is, you know, so what happens at 10 years? Because we think that, you know, it should be kind of shifting the other way probably at 10 years, right? So we've got life proceeds of $467,118, or $188, excuse me. Investment account now is $434,970, total of $902,158. Investment only, $580,000. So at 10 years, we're still in a better situation, right? So maybe at 20 years, is that will it flip at that point in time? We've got insurance proceeds of $630,215, $1,200,000 plus some change in your investment account, total of $1.8 million versus $1.6 investment only. Does that surprise anyone? Okay. I was surprised when I saw this because all my life I've heard insurance is a bad investment. Okay. And I work for an insurance company. So those are the pure numbers right there. Again, we've got some bankruptcy protection if it's covered under ERISA. And again, you know, in some worlds that's incredibly important. We're a pretty litigious society. So recapping on this portion, it increases allowable contribution sometimes in the defined benefit world. So it's going to increase the deduction if that's your focus. We've got pre-tax dollars. We're getting tax deductible premiums. The funds for the retirement benefit are there on day one. I asked this question this morning, how many of us know when we're going to die? Okay. It's pretty hard to plan for the most part. So that's pretty important. And again, the bankruptcy protection. Here's another question I get. Can 100% of the contribution in a retirement plan go for life insurance? You'd like for it to, right? I'd do it if I could. Unfortunately, the IRS says that's not going to quite work. Life insurance has to be incidental to the retirement benefit. So what does that look like? In the defined contribution, which is profit-sharing 401k world, if you're using term or universal life, it's 25% of the contribution. Okay. If it's whole life, it's less than 50%. So you've got some differences there. If you're using term life, what amount is what is considered PS 58 cost, or what is taxable to the participant? The whole premium amount, right? So it might not make sense to ever do term in a retirement plan, quite frankly. So in the defined benefit world, what does that look like? You're either funding for a multiple of the monthly benefit, or we're using Revenue Ruling 740307. So in the multiple, you can go up to 100 times the monthly benefit. Okay. If you're using Revenue Ruling 740307, it's 66 2/3 of the uninsured theoretical reserve. How many actuaries in the room? Like, what does that mean? It's about 50% of the contribution, quite frankly. Okay. You want me to read the whole rule? Here you go. Okay. Another big question we get, what happens at the time that distribution needs to occur if death hasn't occurred? What happens? I've got this life insurance and, you know, what do I do? Well, from a plan perspective, and there are a couple things we can do, but just for some background information, your retirement benefit is the cash value plus your investment fund. Okay, so it's both components. So if you wanted to take a monthly benefit, and you wanted the whole thing as a monthly benefit, you'd need both components to be able to do that. And before I give you the examples, let's just talk about what happens if death occurs. The portion that's taxable is the cash value minus the PS58 cost. The excess death benefit comes out tax-free. Okay. So what that means is the cash value becomes your investment in the contract. You paid PS58 costs along the way, so you recoup it at death. So you've got a much smaller amount to pay taxes on, right? If you didn't do life insurance, wouldn't you be paying taxes on that money anyway? Because it would be in mutual funds or stocks and bonds, whatever. So that doesn't really change that dynamic. The big change is the difference between the death benefit and that cash value comes out tax-free. So we've got life insurance as part of the distribution. Okay, so we move the ownership to the participant, and then they just take the policy out of the plan. At that point then, the cash value is still taxable to the participant, minus the PS58 cost. So there is some taxable portion there. So what if I don't want to have to pay taxes? But I do want the death benefit. Well, there are two ways to do that. You can write a check as a participant. You can write a check for the cash value minus the PS58 cost to the pension trust. That money goes into the trust, becomes a part of your account value or part of your benefit. Then we change the ownership to you as an individual. Comes out of the policy. It's an individual policy at that point in time, and you have all the, the benefits of having an individual policy. Your account is full, made whole because you've paid for the policy. All that can be rolled into an IRA and do whatever you would typically do in that situation. Okay. So what if you say, I want the policy, I can't afford to buy it, and I can't afford the taxes either? So the trust does a maximum loan on the policy. Pulls all the money out down to the PS58 cost that you've paid because you get to recoup that. The loan value goes into your account value or goes towards your benefit. Then we take the policy out of the plan. Now you do have a policy that's got a loan on it and you've got premiums due. So what do we do with that? Well, if we roll everything in the investment account into an IRA, can't you start taking substantially equal payments out of your IRA to either pay the premiums, pay the loan, or both? So you've got that as an option. Fair market value. In our world, fair market value is the cash value. Different companies have different definitions of fair market value, so you just need to be aware of that. And we know life insurance cannot be rolled into an IRA. someone can actually surrender the policy if they do not need the death benefit. Okay. In the retirement plan world, there are situations where there may be a business need to have a life insurance policy, particularly in the owners. Maybe we're working in a key man or a buy-sell situation. We may use the life insurance in the retirement plan to help fund those situations. So oftentimes the owner may have estate tax problems. So oftentimes the owner is going to want to maintain those policies. Okay? Not so much with the rank and file employees, so they typically are going to surrender the policy. If they're not vested entirely, meaning that they're not entitled to it, they only get their vested portion, and the balance goes into the investment fund for everyone else. And that's pretty much it about life insurance in a retirement plan. We don't see it a lot. Lafayette Life is one of the few companies that still does it. But I think it's still a viable situation to do life insurance. Again, a needs-based sale. This was intended to be short and sweet, so I didn't put you to sleep because I know you just ate your cheesecake. And at, and at this time, I'm going to turn it over to Lenny Martin.